Welcome to The Explainer. Today we're taking a deep, fascinating dive into the absolute heart of the global financial system using some really incredible source data. We're going to unpack the rise, the reign, and the intensely debated future of the undisputed heavyweight champion of the world economy. Yep, we're talking about the US dollar. If you've ever wondered why exactly one single currency holds so much global power, how it got there in the first place, or whether its days are actually numbered, well, you are in exactly the right place.
Okay, let's dive into this. 58%. Right off the bat, that is just a staggering number. To put it simply, the US dollar makes up 58% of all global foreign exchange reserves. I mean, think about the hundreds of different currencies out there in the world. The fact that just one of them accounts for nearly 3/5 of all the money held in reserve by central banks globally, it's honestly mind-blowing. It perfectly sets the stage for understanding just how dominant the dollar really is.
But, before we go any further, let's quickly clarify what a reserve currency actually is. Basically, it's a foreign currency that's held by a central bank or national treasury. Think of it like a giant financial safety net. Countries absolutely need them to survive global trade. They use them to weather unexpected economic shocks, to pay for really crucial imports like food and energy, to service their foreign debts, and even to moderate the value of their own domestic currency when things get volatile. Because so much of global trade runs on dollars, holding on to them isn't just a nice to have. For most countries, it's literally a matter of economic survival.
Section 1, the global currency king.
And this brilliantly illustrates the current landscape. Based on IMF data, the US dollar is sitting comfortably at 57.8% of global foreign exchange reserves. Its closest competitor, that's the euro, trailing way behind at just under 20%. Then you've got the Japanese yen at 5.8% and the British pound at 4.7%. The gap here is absolutely striking. It's not just that the dollar is leading, it's that it's leading by a marathon. So it really makes you wonder, how did we get to a point where one country's money dictates the rhythm of the entire globe?
Section 2. The Bretton Woods origin.
Okay, picture this. The year is 1944. World War II is finally drawing to a close, but the global economy is in absolute ruins. Delegates from 44 allied nations gather at the Mount Washington Hotel in Bretton Woods, New Hampshire, which actually is pretty wild to think about, the fate of the modern global economy being hammered out at a ski resort. Anyway, their mission was monumental. They needed to rebuild the international financial system and set up fixed, stable trade rules. The goal was to guarantee they never repeated those catastrophic beggar-thy-neighbor policies of the 1930s that sparked the Great Depression. They urgently needed a unified plan.
Now, what's really interesting about this is the intense intellectual clash that happened between the two primary architects. On one side, representing the UK, you had the legendary economist John Maynard Keynes. Keynes wanted a neutral, global reserve currency, he called it Bancor, that would be managed by a global central bank with shared responsibility. But on the other side was Harry Dexter White, a senior official at the U.S. Treasury. White aggressively demanded a system centered entirely on the U.S. dollar, alongside strict limits on currency speculation. It was a massive battle of brilliant minds with vastly different visions for the post-war world.
Ultimately, though, because the United States came out of the war with just overwhelming economic power and literally controlled roughly 2/3 of the world's gold, Harry Dexter White's plan won. So here was the compromise. All participating currencies would be pegged to the US dollar, and the US dollar in turn would be separately pegged to gold at a fixed rate of $35 an ounce. With that single agreement, the dollar officially became as good as gold. Foreign governments could exchange their dollars for gold anytime, which elevated the U.S. currency to the absolute foundation of the global monetary system.
Section 3. The exorbitant privilege.
So the crucial point here is captured perfectly by former French finance minister Valéry Giscard d'Estaing. He famously called the dollar status an exorbitant privilege. Because the entire world needs dollars to trade and to stock the reserves, there's just a constant, massive global demand for U.S. currency. And this insatiable demand allows the U.S. government to issue bonds and borrow money at a significantly lower cost than other nations. Essentially, the rest of the world provides cheap financing for U.S. debt simply by holding on to dollars.
Let's move to how this builds over time, because you're probably wondering, well, what happened to the gold peg? In 1944, we had Bretton Woods, but fast forward to the late 1960s, and the U.S. simply didn't have enough gold in reserve to cover all the dollars circulating offshore. To prevent a massive catastrophic run on Fort Knox, President Richard Nixon implemented the Nixon shock in 1971, which officially ended the convertibility of the dollar to gold. By 1973, we were fully in the modern era of free-floating fiat currencies. But here's the crazy part. Even without the gold backing, the dollar remained king anyway. The system was already so deeply entrenched, and U.S. financial markets were so large that the world just kept using it.
And the perks of this dollar empire today, they're staggering. Beyond the lower borrowing costs we talked about, the U.S. enjoys a deep, highly liquid $22.5 trillion treasury market. No one else has a safe asset market this big or this easy to access. But honestly, perhaps even more importantly, the dollar grants the U.S. unmatched geopolitical and diplomatic heft. Since almost all trade runs through correspondent banks at the Federal Reserve, the U.S. has the unique ability to impose sweeping financial sanctions. A really striking modern example of this is the power to freeze foreign assets. Just look at when the U.S. and its allies froze roughly $300 billion in Russian central bank reserves after the invasion of Ukraine. That is a jaw-dropping level of international influence.
Section 4. The cost of dominance.
But it's a double-edged sword, right? When everyone in the world wants your currency, its relative value shoots up. Now, a highly valued strong dollar might sound great on paper, but it actually makes U.S. exports significantly more expensive for the rest of the world to buy. This macroeconomic dynamic drives sustained U.S. trade deficits and directly hurts domestic industries that rely on selling their goods abroad. Over the decades, this strong dollar reality has contributed heavily to manufacturing job losses in places like the American Rust Belt. So while the government gets cheap debt, everyday American exporters and manufacturers are often the ones paying the price in lost competitiveness.
Section 5. The de-dollarization debate.
This brings us to the buzzy topic of de-dollarization. Unseating the king is incredibly difficult. Let's objectively look at the major challengers and the fundamental structural flaws holding them back. First, there's the euro. It's the closest runner-up, used in about 20% of global reserves. The problem? The Eurozone lacks a unified European bond market, meaning there isn't a single massive safe asset for investors to buy, like U.S. treasuries. Second, China is heavily pushing the renminbi for bilateral trade, but strict capital controls by Chinese policymakers limit its free movement, making it super unappealing for broad international reserve use. Third, you've got the BRICS nations discussing a shared currency framework, but they completely lack the robust central banking systems and unified monetary policies you actually need to manage something like that. And finally, what about crypto, like Bitcoin? Well, while it's decentralized, its extreme volatility makes it pretty useless as a stable reserve, and adopting it completely constrains a government's ability to respond to an economic crisis. So, while countries really want an alternative, every single current option has a massive fundamental flaw.
Which leaves us with a final, really provocative thought to chew on. As countries continue to push back against U.S. financial dominance and constantly seek workarounds, we have to ask ourselves, if the U.S. dollar eventually does lose its throne, is the world truly ready for a global financial system guided by non-U.S. values? You see, the dollar's reign isn't just about money. It's intricately tied to the rules, values, and norms of the current international order. A de-dollarized world would look vastly different, carrying massive implications for global trade, human rights standards, and geopolitical power structures. It is a profound question to ponder as we watch the future of the global economy unfold. Thanks so much for joining me on this explainer, and keep asking the big questions.